Hi friends, my name is Sahil and this is my Personal Finance Academy. I recently conducted a poll where I asked, how long are you investing in the stock market? And trust me, I was shocked to see the results. I knew that a lot of people have started investing in the stock in last 1 year, especially after the series on 1992 scam. But the poll results were surprising. I received around 32,500 votes so far, and 80% of the voters are those who have started investing in the stock in last 3 years. And within that, 57% people have recently started investing in last 1 year. Now, I was not expecting such high numbers. This poll clearly suggests one very important pattern. Majority of stock investors that are on YouTube are naive and have little to no experience in the stock market. And the major reason behind this huge rise in new breed of stock investor in last 1 year is due to the sharp rise of the Indian stock market in last 1 year. Obviously, when the stock market rises, it attracts a lot of new investors. Now, a new investor has no knowledge about stocks. So one of the best options is YouTube, isn't it? No wonder. There are so many YouTube channels on the stock market. But the problem is that stock investment is not a cakewalk. Yes, the market has jumped a lot in last 1 year and created huge opportunities to create wealth. But you need to understand that market doesn't always go up. It also fall. And when the market fall, a lot of new investors panic and exit from the stock market. The reason is simple: lack of knowledge. Generally, a new investor in the stock market has only one mindset: generate multi-bagger returns in no time. This reminds me of one very popular meme on the internet: 21 दिन में पैसा double. But if making money in the stock market was that easy, everyone would be a millionaire by now, isn't it? In fact, you will find more losers than winners in the stock market. Now, there are multiple reasons for it. So in this video, I want to share 5 lessons with new investors in the world of stock market to avoid loss and create wealth in stock market. So if you are someone who has recently started investing in the stocks, then this video would help you in your stock market journey. Alright, let's get started. Lesson number 5 is that stock market doesn't always go up. If you have started investing in last 1 year, then you are probably under the impression that the stock market only goes up. The moment a new investor invests in the stock, he or she only wants the stock price to go up like a rocket. But my friend, stocks are not like rockets. They do fall. And when they fall badly. If you look at the last 40 years of history of Sensex, then you would notice that there are a lot of ups and downs. In other words, we call them bull and bear market. So basically, in the bull market, there's a state of euphoria where the stock gives huge return and this attracts a lot of new investors. However, when the stock rises a lot, they become overvalued and eventually the stock market corrects. That's called the bear run. And that's where the new investors who entered when the market was at the peak or near the peak loses a lot of money. Now, how much a stock market could fall? It could fall as much as 50 to 60%. Friends, I'm not trying to scare you, but I just want to show you the reality of the stock market. In fact, right after COVID, Sensex and Nifty tanked around 40%. Now, the amount of correction would vary. It could be 10%, 20%, 30%, or even 40 to 50%. And even the duration of bear market would vary. For example, the market crash of March 20 due to COVID lasted only for a couple of months before it started recovering. However, there have been long period of bear market. It could be up to 1 to 2 years or up to 3 years. It happened during 2015-16, during 2010-12, during 2008-9 and many times in the past. So one thing is for sure, if the market is going up today, it will eventually correct. When will it correct? I don't know. In fact, nobody knows. So the point I'm trying to make is that be very clear that stock market are very volatile. However, the long-term growth trajectory is always towards an upward direction. So when you invest in stocks, be ready to take that hit in your portfolio as it is a part of the game. The only thing you need to ensure is that you don't get too fearful. And that takes us to lesson number 4. Lesson number 4 is control your emotions of fear and greed. Stock market is full of emotions of fear and greed. A 10% rise in stock can make you greedy, and even a 5% fall can make you fearful. This emotion of fear and greed is at its peak with new investors. If they invest in a stock and it rises 30 to 40%, they think that they've made the best investment decision. And when the same stock corrects by 10 to 20%, they would get fearful and start doubting their investment decision. In fact, the rise in the stock market in the last 1 year has resulted in a lot of greed in the market and hence attracted a lot of new investors who are dreaming of generating multi-bagger returns in no time. But the majority of them have entered at high levels. And like I said, when the stock market rises, it eventually corrects. And when the market will correct, a majority of new investors would become fearful and would start panic selling. Trust me, fear and greed are two biggest enemy of stock market investor. If you get too greedy when the market is rising and get too fearful when the market is falling, then you can't create wealth in the stock market. So remember that you need to control your emotions of fear and greed. Lesson number 3 is diversify across asset class and sectors. Lesson number 3 is more towards the investment strategy. Now there are various categories within stock market. For example, you have large cap category, mid cap category, small cap category, and even micro cap category. This is based on the market cap of the stocks. Then you have various sectors like your IT, pharma, banking, FMCG, metal, energy, etc. So the most common question that comes in the mind of a new investor is, should you invest in large cap or mid cap or small cap? Obviously, the small cap looks very attractive as they rise even 10 to 20% in a day. Whereas your large cap looks very boring as they move very slow. Or now that technology is booming, should you just invest all your money in technology stocks? Well, the answer is none. You need to diversify your money across large, mid and small cap category and across sectors like your IT, pharma, FMCG, chemical, banking, etc. The reason is simple. While small caps have higher return potential than mid and large cap, they are also more volatile than mid and large cap. So when small cap can give 50 to 100% return in no time, they can also fall quickly. In fact, if you have been investing in stocks since last 3 years, then you would have seen how the small cap sector crashed almost 40% during January 18 till August 2019. I remember investors used to curse small cap stocks during that time. Hence, it is important to make a fine balance where large cap gives the stability and mid and small cap category give the growth opportunity. Also, you should not invest in just one or two sectors as sector specific investing is very risky. One bad news for the sector can result in heavy losses. Hence, make sure that you invest across sectors. As far as individual stock is concerned, make sure that you do not have a very high exposure in a particular stock. For example, I have a rule that I don't invest more than 10% of my money in a single stock, no matter how good a stock is. That's how I reduce my risk. Now lesson number 2 is, do not try to time the stock market. The most common question I get is, Sahil, Sensex has crossed 57,000, Nifty has crossed level of 17,000, market is currently looking overvalued. Should I invest or should I wait? This is the biggest dilemma of an investor. Ideally, everyone wants to invest when the stock is at the bottom and sell when the stock is at the peak. But the problem is that when the stock market is overvalued, people do not invest thinking that price is too high. And when the market falls, the same set of investors still do not invest thinking that market will fall even further. So basically, they don't invest at any level and end up losing out on the growth opportunity in the stock market. For example, during COVID crash, when Sensex fall from 42,000 to level of 26,000, there were people who did not invest, thinking that Sensex will fall even further. Today, they are regretting their decision. See, nobody knows when the market will rise or fall. If you have faith in the growth story of the Indian economy, you should invest systematically without worrying too much about the valuation. For example, currently the majority of technology and chemical stocks are available at higher valuation. But does it mean that you don't invest in them? No. It is just that you should invest systematically. And if there is a correction, you should take that opportunity to invest more. Of course, here I mean the quality stocks. Now lesson number 1 is, do not invest blindly on tips. This is the most favorite activity of majority of new investors. All they need is a tip. Most of them are not interested in knowing anything about the company. Just tell the stock name. No wonder the world of stock market is filled with every Tom, Dick and Harry giving free stock tips. Be it any platform like Telegram, YouTube, WhatsApp, Facebook, etc. You'll find many people giving free stock tips. In fact, there are a lot of articles that say Rakesh Jhunjhunwala has invested in X stocks. His X stock has given 100% return in 3 months, etc. What happens next? A lot of retail investors get influenced and would also invest in that stock. Trust me friends, majority of them have no clue when Rakesh Jhunjhunwala would exit and the price would fall and they end up in loss. So don't buy based on tips. Do not even blindly invest in stocks purchased by top investors. And do not even blindly invest based on my stock reviews. Make sure that you do your analysis and only invest if you get convinced. In fact, in every video I say that my videos are for educational purpose and my intention is to help you understand the business of the company and I just give my point of view. But unfortunately, a lot of people blindly invest based on my review without knowing anything about the business, and when there's a slight correction, they panic. Because they don't have any clue about the company. All they care is they invested at X level and now it is showing loss. Well, personally, when I invest in stocks, I ensure that I only pick the fundamentally strong companies, and when they fall, rather than panicking, I buy more. Friends, the entire idea behind this video was to give you a reality check that stock market is not a fairy tale story. If it was that easy to create wealth, nobody would have kept their money in FD. Stock market is very volatile and when it rises, it also falls. The only way to create wealth in stock market is to keep patience and invest in a disciplined way without getting too greedy on the rise and without getting too fearful on the fall. Yes, the most important point is to ensure that you invest in fundamentally strong companies and make sure that you also do your own research before investing your hard-earned money. If you want to learn more about how to pick the right stock, I have a complete course on money management. Finally, I want to close this video with a short story. So one day, Jeff Bezos, the founder of Amazon, asked Mr. Warren Buffett, "Warren, your investment thesis is so simple and yet so brilliant. Why doesn't everyone just copy you?" Do you know what was Warren Buffett's reply? He said, "Because nobody wants to get rich slow." And that's the reason why majority of people fail to create wealth from the stock market. They want to get rich in no time. Thank you for watching this video. I hope you will find it useful. I'll see you with another video. Till then, take care.